Who doesn't love the idea of paying off their student loan debt faster without having to do that much more work? I've got this amazing list of 23 tips to pay off your student loan debt faster. And while all of them might not apply to you, any one of these tips could save you thousands of dollars in student loan interest, particularly if you have a very large balance. So let's get started. Number one is putting your student loans on Autopay. Most companies will give you a 0.25% interest rate discount for setting up your student loans on an Autopay system, which means that it's going to come out directly from your bank account. For some people that really struggle with monthly bills, this might not be possible. But if you can afford to do it, setting up your student loans for Autopay is a great way to save a little bit of money on your interest while also making sure that you're not late with your payments. Number two is making biweekly payments on student loans. A lot of people don't realize this, but if you pay your student loans, most people will pay once a month, right? However, if you wanted to, you could set up your student loans biweekly, which would kind of coincide with your paycheck. Now, not every student loan servicer allows this, but certain ones do. And if you ask if you can set up biweekly payments, what that's going to do is it's going to get you extra payments going towards your student loan debt every year, because if you get paid 26 times a year, if you just take the amount you had monthly and you sort of divide that by 2, and then you make those payments biweekly, then that's basically 2 extra payments coming at your student loans per year, which is going to get you out of debt maybe 10% faster, let's say, maybe even more than that. So biweekly payments is something that it really makes sense for a lot of people, and it's kind of timed up with your paycheck. So it really does make a lot of people really excited about getting rid of their student loans with this strategy. Number 3 is refinancing. You can cut your interest rate in some cases by 1, 2, or even 3% by refinancing your student loans with a private lender. On top of that, through Student Loan Planner, we actually have the biggest cash bonuses anywhere on the web. To get one of those, you would just go to studentloanplanner.com/refi, R-E-F-I. We'll put that link in the description below. And you could get a cash bonus of $1,000 or more, and you could get a much lower interest rate, which would cut your time in debt significantly, as the money that would have gone to interest can now go towards paying off principal instead. Number 4 is the Debt Avalanche method. Essentially, the Debt Avalanche is different from the Debt Snowball. The Debt Snowball is when you target your smallest loans first. The Debt Avalanche goes after your highest interest rate loans first, and then you work your way down. Now, while this might not be as emotionally gratifying as getting rid of small loans and getting small victories, it's mathematically the right thing to do. So for example, if you're trying to get rid of your student debt and you've got loans at 5, 6, or 7%, which are higher than the others, you might target those loans first and get rid of them so that you can then focus your energy on the next highest interest rate. Number 5 is making payments while still in school. Now, this might seem kind of crazy to think about, but yeah, you can still make payments in school, and student loan interest continues to grow in most kinds of student debt while you're still in school. So if you're able to make payments on the debt that you're taking out for school, then that's going to lower the amount of interest that you have to pay back, which is going to get you out of debt faster. Now, of course, you might say, well, if I was able to make payments in school, Travis, maybe I wouldn't take out student loan debt in the first place. So we recognize that this strategy really isn't possible for everyone. Number 6 is the student loan interest deduction. This is not really that big of a deal, but if you have an income that qualifies, which most middle-class incomes qualify for this, you can deduct up to $2,500 of student loan interest that you pay every year against your income. And with the standard deduction being significantly higher than it's been in years past, some people have not been able to itemize. The good news is that the student loan interest deduction is called an above-the-line deduction, meaning that it does not depend on you actually itemizing on your taxes to be able to claim it. Now, a student loan company is going to give you a tax form every year to show you how much student loan interest that you paid, and if it's enough to claim, you could claim this and save probably hundreds of dollars on your income taxes, maybe even over $1,000 on your income taxes. So certainly it's not a game changer, but it's definitely a nice extra boost of money that can go towards debt. Number 7 is paying off private student loans first. Private student loans are much more dangerous than federal student loans simply because private student loans absolutely must be paid back. Federal student loans, in contrast, can be put on income-driven repayment plans and even put into forbearance for up to 3 years if you're having economic distress. Therefore, private student loan debt, even sometimes if it has a lower interest rate, might be the first priority to get rid of simply because that monthly payment can be ominous if you're going through a period of economic uncertainty. So for most situations, you might consider targeting your private student loan debt unless you're quite well off and it's not really that intimidating to you to have an extra monthly payment to combat. Number 8 is only going to apply to you if you have student debt in your family from your kids' education. So for a lot of people, you can take your Parent Plus loans or loans that you took out for your kids' education, and you can have your kids assume that debt with refinancing into their own name. So maybe even you might have student debt in your own name on top of debt you might have for kids. Hopefully that's not the case. Hopefully you're just dealing with debt that you have. But if that was the case, companies such as Common Bond and Laurel Road will allow a child to take debt away from a parent that borrowed for the kid's education, provided that the kid's able to qualify for refinancing. The lower interest rate that you get gets the family unit out of debt faster as well. Number 9 is the standard repayment plan. This sounds simple, but a whole lot of people will sign up for an income-driven plan, and therefore they'll end up paying more in interest over the life of their loans because the monthly payment they're making isn't large enough to get out of debt rapidly. The standard repayment plan is rarely the right plan to use long-term, simply because if you're doing that plan, you probably could refinance your federal debt to a private loan at a lower interest rate. That said, though, the standard repayment plan should result in about 1% of what your balance is owed every month. And if you make that kind of a payment consistently, then your debt's probably going to be gone in about 10 years. So it sounds really simple, but using the standard repayment plan is an effective way to get rid of debt because you're just simply making a very large monthly payment. Number 10 is keeping yourself on an income-driven repayment plan. This, again, might be kind of counterintuitive because some people use income-based plans to go for forgiveness. But a lot of people who eventually end up paying off their student loans are in and out of income-based repayment constantly. What that does is it capitalizes any accrued interest every time it happens, and then you compound your interest almost continuously in some cases. A lot of people that are just so frustrated when they, talk about how they've paid more than they've actually owed in student debt, and yet somehow it's still larger than what they borrowed. This is usually a failure to recertify income-driven repayment. I'm not saying that that's that person's fault or anything. I'm just saying that often is what happens since the student loan servicers are very terrible. So you need to make sure that you're recertifying your income-driven repayment if you can't afford to make large payments to pay down the debt every month, because what it does is it makes sure that your interest is simple interest instead of compounded interest. Number 11 is avoid forbearance. Every time you go into forbearance, it capitalizes your interest when you come out. Yes, you get up to 3 years of forbearance on a federal student loan, but you really should not use it unless it's absolutely necessary. Another reasonable use of forbearance is if you have private debt that needs to get paid down very quickly, you might consider using forbearance on a federal student loan so that more money can go into the private debt, but in general, you should avoid it. Number 12 is avoid default. Default is something that can add as much as 25% in collection fees, as well as compounding interest and all kinds of extra charges that you just don't need. If you were facing a default on your federal student loan, it's very, very easy to sign up for an income-driven repayment option like revised pay-as-you-earn, where you can pay 10% of your income, and then you don't have to worry about being able to make this monthly payment, because if you really are making poverty line wages, your payment could be as little as $0 a month. A lot of these places, unfortunately, don't have a very good incentive to get you out of default once you're on it. So please, please, please avoid default. It is extremely costly and it will add a long time to your student loan repayment journey. Number 13 is pay off your accruing interest. Whenever you refinance or try to pay your debt off, or switch into a different income-driven repayment plan, or come out of a deferment or forbearance or anything, you are going to have your accrued interest capitalize. That's a big deal because it just basically adds additional interest charges throughout the life of your loan as you're paying it back. So if you want to try to minimize your interest charges, then definitely try to keep up with your accruing interest if you can all afford it. Number 14 is file separately for taxes when appropriate. Now, there's usually not a good reason to file separately for taxes, but with the American Recovery Act that President Biden signed, in some families, filing separately could mean qualifying for thousands of dollars in expanded child tax credits. Other times, for student loan borrowers that might have other more important private student loans to pay down first, you might be able to file separately and reduce your federal student loan payment so that you could get more money to use in your private student loans. So usually filing taxes separately is better for people that are not looking to pay off their student debt, but some people should certainly consider it. Number 15 is avoid student loan scams. It is so easy to fall prey to a lot of these organizations because they often emulate the federal government in mailers they send out, or they leave threatening voicemails, or they send emails to you that are just not true. And the whole point is to try to convince you to pay for something that you can do for free on studentaid.gov. Now, as a company that provides student loan advice professionally, let me say that there is a difference between student loan scams and student loan plans. A student loan scam is essentially they fill out a piece of paper for you to sign you up for an income-based payment plan, and that's all they do, and you could have done that for free, and they don't even explain to you which plan is best and why. So a scam group, it's hard to say that, if something's just a terrible deal and these people are providing a bad service versus something that's a scam, right? So any group that's like a document preparation service, I would steer clear of, because a document preparation service is not going to give you actual advice. They're just going to take your money, right? And in the more extreme cases, these groups will try to make you think that you're making payments on your federal student loans, but when in reality, they're just taking your payment for themselves, knowing that the federal government and the FTC is going to take less money from them eventually than they're going to get to keep in their profits. And in some cases, they even funnel these profits overseas. So obviously, if you fall prey to one of these student loan scams, it will extend your length of repayment on your student loan debt. Number 16 is sign up for any employer student loan repayment benefit programs that you're eligible for. So you might not know this, but with the CARES Act and then the December 2020 stimulus bill, employers can now make tax-free student loan repayment assistance up to $5,250 a year if they happen to have a program that qualifies under the IRS guidelines. This is an education assistance program offered by an employer, and your employer has to jump through some hoops to set it up, but that's $5,250 of tax-free money that you might be able to qualify for. So I would expect more and more employers are going to offer programs like this in the future, because this is a pretty attractive tax benefit that's tax-free to the employer and the employee. So ask your employer about this benefit and see if they have it available, because it could save you a few $1,000s in taxes. Number 17 is pay loans while you're in your grace period. This is kind of like paying loans while you're in school, right? When you come out of school, you have a 6-month grace period. Generally, we tell people to consolidate right away into a program like Revised Pay As You Earn to get an interest subsidy for that. But if you happen to forget and you're making money, you don't have to stop, you don't have to wait to make payments until your grace period ends. Getting started on paying down your student loans as soon as possible might sound tautological, but that will get you out of debt as fast as possible. So if you can, make payments at all times on your student loans, including these grace periods. 18 is invest in a student loan plan. We've made this list of 23 tips to pay off your student loans. We're not done yet, but if we made a list of 23 tips when we actually have probably 100 different tips of getting out of student loan debt faster, you might benefit from paying a few $100s for a professional like somebody from studentloanplanner.com who can analyze your situation and figure out which of the loopholes and strategies best fit your situation. So if you have the money and you don't want to watch every single one of our YouTube videos, this might be a way for you to get out of debt faster just by working with somebody on our site. So studentloanplanner.com/help is a place to check that out. Number 19 is pay more than the minimum payment. Sounds silly, but there's no prepayment penalty on student loan repayment. So you should be paying extra when you can. Some people like to take their bonuses and throw it on the debt once a year. Some people like to make an extra payment every month. Some people like to set up BiWeekly payments so they can make extra payments on their loans, which we talked about earlier. But if you can, pay off extra on your student loan debt. Student Loan Planner actually has some great calculators and resources for this to show you how the impact of an extra payment on your student loans can get you out of debt that much faster. Number 20 is go back to school. Sounds kind of nuts, but what matters is your earning power, not the amount of your debt. So if you realize that you can go back to school, if, for example, say you're a chiropractor that is making $50,000 a year and you realize you could go become a nurse practitioner and make twice as much money, that's probably going to make sense to do that, because it's going to give you additional earning power to pay off your student loans if you really want to do that. Now, this might sound kind of weird, but think about a case where you have a for-profit job where you're going for forgiveness over 20 years, and then you can go back to school and get a job that's going to put you into a not-for-profit setting, kind of like that chiropractor to nurse practitioner example, right? Whereas a chiropractor, you'll work in a private sector setting, and then a nurse practitioner will work in a hospital setting. And so you might gain access to something like public service loan forgiveness, have your debt forgiven in 10 years instead of 20, and make twice as much money. So it might not be as easy as paying off your debt from the traditional sense, but it is paying off your debt. You're just having the government pay off your debt for you 10 years faster while earning more money. So certainly consider going back to school if you're not happy with your current career prospects. 21 is keep your credit in good shape. It might sound silly, but if you can keep your credit above a 650, you will qualify for the best student loan refinancing offers, the lowest interest rates, and you're going to save more money on things like a mortgage and car payment, which will allow you to put more money towards your student loans. Number 22 is the student loan refinancing ladder. This is a strategy that Student Loan Planner came up with specifically to help people that don't want to overcommit to a monthly payment still save a lot of money in interest. The way it works is you start off with a 20-year fixed with a monthly payment that's pretty low, but you pay a lot more than you have to. Maybe you pay extra a month, maybe you make big lump sum payments, but you want to try to pay that debt off down to about half of what you started with. Then you can refinance that loan to a 10-year and have a monthly payment that's about the same. Then you pay off that loan to about half of that earlier amount, and now you can refinance to a 5-year and get the lowest possible interest rate while having still about the same monthly payment. Every time you refinance, if you go through Student Loan Planner as well, then you get an additional cash bonus for doing so. Number 23, finally, we made it to the end of the list, consolidate federal debt. If you consolidate right after graduation, you can get signed up for something like the revised Pay As You Earn program and get an interest subsidy as much as 50% of your interest 4 months sooner than if you wait out the grace period. It's a great strategy to minimize your interest, and you can pay extra and it does not affect the revised Pay As You Earn interest subsidy. So those are our 23 tips for paying off your student loans faster. In this next video, we have 9 highly effective repayment strategies for student loan borrowers. If you have a tip for paying off your student loans faster, leave it in the comments below, and thanks for watching.